When I first look at an executive summary, I'm trying to figure out like some of the major things that we look for when we're doing a deal. One, off market. Two, value add. Three, track record. Sub markets. The model, right? Has it been proven out? Have they done this before? Equity multiple, meaning how much is your money going to turn into? And then the unit count. So we'll just go through all of these real quick and talk about why we like to see those kind of buzzwords in the projects. Welcome back to the Free from Wall Street podcast. Thanks so much for tuning in. Today we're going to be talking about how do you know when a deal is good? If you're getting into passive real estate investment, you're probably talking to a lot of different sponsors or what they call syndicators, people that are basically pitching their deals to you and other people like you. And what should you be looking for to find out if a deal is good? This is an important step in the process because every marketing packet, business plan, they all look different, right? And some are low-res photos from somebody's phone and kind of pro forma, an Excel spreadsheet and things like that. And there's also these really high-end 50-page, 60-page investment summaries giving you extreme detail, a lot of graphics. And it really depends on the personality type of the sponsor, right? And also of you to see what really stands out to you. So, I like pretty pictures. I like bright colors. I like graphs and charts. But that doesn't make it a good deal. So they're like snowflakes, right? No two of them are exactly the same. And you have to look past the initial impression that you're making or that's being made upon you to know if this is a good deal. So what should we look for? We're going to go through a sample investment summary. If you would like to see a previous investment summary of ours, just reach out to me or Celia, and we'll make sure that we get you some of those so that you can take a real good look and get used to seeing some of these types of things, right? So what are we going to be putting in there? We're putting in the project name. There's going to be a bunch of photos of the property, and we're going to talk about the area, the overview of the submarket, why we like investing there, and then the overview of the deal. How many units? What's the purchase price? How much equity are we raising for it? The details of the business plan. How are we going to increase operational efficiencies? Are we going to increase the net operating income, decrease the expenses? What's the previous management like? What's our management plan? Stuff like that. And then projected returns and exit strategies. What can I expect in terms of returns, and how is that pro forma put together? And then a detailed number and analysis. So we're going to be digging into the actual line item expenses, the line item income, the line items of the strategies. And then you'll see our team bios on there. You'll see who our partner is. You'll see who we are. You'll see our legal team. You'll see the accounting team. And do your research, right? Google's fantastic. Just use a quick Google search of these different firms and things and just kind of get a good feeling of who the team is behind it. What kind of experience do they have? Stuff like that. So when I first look at an executive summary, I'm trying to figure out like some of the major things that we look for when we're doing a deal. One, off market. Two, value add. Three, track record. Sub markets. The model, right? Has it been proven out? Have they done this before? Equity multiple, meaning how much is your money going to turn into? And then the unit count. So we'll just go through all of these real quick and talk about why we like to see those kind of buzzwords in the projects. So number one, off market. So most of our deals have been acquired off market, which just means that it hasn't been put on, the commercial MLS, for lack of a better term, or CoStar. This is where deals are getting publicly marketed. Now, it's not to say you can't find a deal in a publicly marketed venue, but it's a very competitive world right now, finding these deals. So relationship is key. And if you can build relationships with brokers or sellers directly, that's how you're going to find really good deals, right? It's going to be a quiet transaction. You're going to make a deal with the seller. Once it goes to market, just like you see in the residential market, once it hits the market, everybody's eyes are on it. So it's not to say you can't find a good deal. It's just to say that you're going to have to compete. And when you compete on price, you usually lose. So now we're trying to make sure that our purchase price is more reasonable. The second is the value add. Value add is exactly what it sounds like. How are we going to be adding value? Often when we do these multifamily complexes, we'll go in and we'll have a renovation policy, and we'll know exactly what we're going to be doing to each unit when a tenant moves out to maximize the value, really create more rental income by being able to increase those rents to either market or just below market. And that's what your CapEx budget really is. So your value add could be kitchens, baths, floors, doors, trim. It could be as simple as just what we're doing in our next project, where it's just there's already washer dryer hookups in there. And we've proven out the model. We see that if we add washers and dryers in the units, then we can charge X more for that particular unit. So whatever the value add plan is, right? Maybe it's net operating income, maybe it's expense reduction. Those numbers add up, right? If you're doing a 200 unit complex and you can get an extra $50 per complex, you're talking about significant higher rents because the building is nicer, because the grounds are nicer, because maybe you've painted the exterior, done a new parking lot, things like that. So how and where are you adding value? That should be detailed in that investment summary as well. And then track record. So how long have they been in business? How many deals have they done? What's their asset under management look like? And that all speaks to experience. I mean, we like to do business with people that we know, like, and trust, but we really should be looking at their experience as well. How many deals have you done? What was your success or failure rate in previous apartments that are similar to this one, so that we know what the value add look like, we know what the submarkets look like, So a strong reputation is everything. And this is why these conversations are important with the sponsor too. So you can go through the track record and say, why do you like this? And that's what the conversation is that we're having with sponsors as well. So, we are now working with institutional grade sponsors, which means, Wall Street type of operators that now have taken a liking to us, and we've taken a liking to them, and we like their track records. And we also like where they invest, which leads us into strong submarkets. So submarkets are, the city or the suburb or the, secondary area that they're in. And why do we like investing in those areas? If you look at our portfolio right now, we are in Orlando, Daytona, Columbus, Dallas. You're talking about 4 of the top 10 markets in the country. What that means is it's pretty competitive to get deals there, but it also means that you have large population growth, large economic growth, large job growth. So if it's the fastest growing or second fastest growing or 10th fastest growing, things like that, we like to see that. And then I also like to see the submarket. So if I'm looking through an investment summary, I like to just go on Google or Google Earth or Google Street View, and I like to drop and drive around. Like, let's see what the area is like. Why do we like this area? And then next, what is a proven model? So what I love is, especially in this next project that we're doing, it's like, half of the units have done the washer dryers. And in those half units, we're achieving an extra $50 a month in rent. Well, now we know what the rent premiums are. It's already been proven out. So we don't have to just go off of projections, which, projections are fine, but nobody has a crystal ball. We need to figure out if that model is proven. So it just lowers your risk profile when you see a proven model. Unit count. So unit count is important because, we now look for 100 units and above. And the reason that we do that is because of economies of scale. When you have 1 unit empty out of 100, right, you have a 1% vacancy rate. Well, let's do that on a 200 unit or a 300 unit. So the economies of scale lower your risk profile as the larger investments become available. So, we started in the 66 unit range. We've got some 84 units, 120 units, now 384 units. So, it grows, and you start to recognize that the absorption of problems or vacancy get absorbed much better in a larger complex. So we're always looking for economies of scale. So we're always looking to increase efficiencies by leveraging shared resources across many units. And that's why we're starting to do much larger deals. Finally, move quickly. These deals fill up fast, especially as more and more people, the longer that it is between 2 deal cycles, right? We haven't done a deal in almost 4.5 months. Our investors are ready to deploy capital. So When you see an investment summary, go through it. Make sure you're jumping on a webinar, jump on the call with the sponsors. And when you're ready, raise your hand and make sure that you get signed up for the deal, because the boat is going to sail one way or the other, right? So you don't want to be on the shoreline when that ship has sailed, but make sure you get all of your questions, right? So move quickly, but also make sure you're moving cautiously. Do not just pull the trigger because you see a pretty packet, right? And then if they have more information that you want to ask for, then you can go ahead and ask for some more details or jump on that private call like I mentioned. And that is really it. So, I mean, those are the things that we like to look for when we're looking for a good deal. There's other factors, of course, but those are the tops of the waves. The numbers have to make sense. The team needs to make sense. The area needs to make sense. That's why we like investing in real estate, because we can touch it, feel it, look at it, and say, this is a good area. This is a strong risk-adjusted investment. So if you guys are interested in making sure that you are seeing our investment summaries, make sure you go to integrityhg.com and sign up for our investor club. And then you'll make sure that you're getting on our newsletter and you're getting our email alerts when we have new deals and new projects. And if you just want to go there to schedule a call with me, say what's up, make sure you do that as well. So thanks for listening to the Free from Wall Street podcast on how to find a good deal.